Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 105th CP program organized by AASB of ICI for this council year. Within a time span of 2.5 months, we have conducted 105 CP programs for our members. And we have conducted a series of webinars on key audit consideration in the audit of listed companies. Now, today we are going to start a 3 days, three series of webinar on CARO. We have divided CARO into various clauses, and today we are going to cover 6-7 clauses relating to the clause by clause discussion on the CARO. And the topic is very relevant. And in order to tackle these 6 and 7 clauses, we are having with us very eminent, very learned, very respected from our own chartered accountant fraternity, CA Sandeep Dinodia ji. So on behalf of AASB of ICI, I extend my warm welcome to you, sir, for giving your kind consent for today's webinar. Thank you so much, Sandeep, sir. We are also having with us two young chartered accountants, CA Nikita Jain ji and CA Kunal Basin ji. Both are moderators of today's webinar. So I welcome Nikita ma'am and I welcome Kunal ji for this webinar. I also welcome all the participants of today's webinar. And we would going to apprise all of you about this today's webinar. And in order to start the further proceedings as well as about the webinar, I request CA Kunal Basin ji to please start the further proceedings of the webinar. And sorry, Honorable Chairman sir and both Vice Chairman sir both are stuck up in another meeting. So we are taking this liberty to start the webinar. So Kunalji, over to you for further proceedings of the webinar.
Thank you so much, Anil sir. Thank you so much for setting the outset. So I would just like to say, maybe in the absentia of our Chairman Sir Sanjeev Singhal sir and Vice Chairman Sir Vishal Doshi sir, we would be starting off with today's webinar. Like sir mentioned, the 105th webinar on a very relevant accounting topic in terms of assurance, which is CARO. And we have, like sir mentioned, we have with us in our presence esteemed Mr. Sandeep Dinodia sir. So just to sort of set the tone right at the start, I would just sort of give a brief as to the topic, the objectives that we would like to achieve today with the topic. So today we're going to talk about 6 clauses on CARO. CARO, as the name suggests, it's Company Auditor Report Order 2020. Now, this was formulated by the central government under Section 143 of the Companies Act in consultation with the NFRA, which is a body that's constituted under Section 132 of the Companies Act. The 6 clauses that we would cover today would be very relevant in terms of the auditing assurance practical procedures that we do in our daily lives, and we sort of report on it. The first clause of para 3 of CARO 2020, which deals with property, plant, and equipment. While I'm being cognizant and not going into detail in each of these clauses, because I would like to sort of have the wisdom and deep experience of Mr. Sandeep Dinodia sir to dwell in it in a deeper form later on. So just my objective would be just to give an overview. So my first clause of para 3, like I said, would deal with property, plant, and equipment. My second clause of para 3 of CARO 2020 deals with inventory. The 14th clause that we will be discussing today, of para 3 of CARO 2020, will be dealing with internal audit. The 15th clause dealing with non-cash transactions. The 18th clause dealing with resignation of statutory auditors. And lastly, the 20th clause dealing with CARO, with the CSR responsibilities. So now, without any further ado, handing over the mic to Nikita Jain, who would like to sort of introduce our esteemed guest, Mr. Sandeep Dinodia, sir, to the participants of our esteemed fraternity. So over to you, Nikita.
Thank you, Kunal. Our guest speaker for today is Mr. Sandeep Dinodia. He has completed his Bachelor of Commerce from Shriram College of Commerce, Delhi University in 1983 and his LLB from Delhi University in 1986. He is also a FCA with the Institute of Chartered Accountants of India since 1984. He is also associated on the board of directors of many large public listed companies as an independent auditor, offering his invaluable guidance on the company's policies related to good corporate governance and solve their compliance issues with myriad of laws associated with SEBI, Companies Act, FEMA, etc. In his capacity as the insurance head of SR Dinodia and Co. LLP, he is also involved in supervising statutory audit, internal audit, management audit, banking institution, various large companies and private sector companies for more than 35 years. So we are really honored to have you as a guest speaker today. So I would request you, sir, to please start your deliberation.
Thank you so much, Anilji, Kunal, and Nikita, for these kind words of introduction. Uh, yes, I've been in this profession now. This is my 40th year, and I've I've learned a lot from all the youngsters that have gone through our firm, and every day I feel I'm learning. So I'm very excited to do these seminars because it gives me a chance to read, to interact with young people, and to get new points of view because there's no end to learning and no end to understanding. And there is no perfect answers, especially in auditing, that you must have all seen by now. There is this always auditor's judgment that comes into play at all stages of the audit. Now, we also have the two parts of doing an audit. When we issue the final audit report, is the final culmination of the audit work. And this audit report is formulated by the Government of India, by the Accounting Standard Board, and the ICAI, and the Companies Act. And also, we have guidances of the Institute of Chartered Accountants of India on these rules of audit report, some of which the 6 clauses that we're going to address today. So, each of these clauses is very vast and can go, it probably needs a seminar each on each of the 6 clauses. But we will try to summarize and look at each clause from a little practical point of view on how it really, everybody has read the clause, everybody knows who's become a chartered accountant has given an exam, he knows what this clause is all about. So we should, I want to do the seminar a little differently, and I requested Kunal and Nikita to let's do it jointly. I will introduce the topic. I will give you my point of view on what this clause is all about. Then I would request Kunal and Nikita to give their points of view, and let's have an interactive session on what they have faced during their course of work, what I have faced during my course of work, and how have we solved problems relating to each of these, and what are the issues which our members who are going to issue these reports. And now the audit season has started, so these reports will be issued, and there is a quality review, there's a NAFRA, there are so many boards on top of us now who are looking at each and every wording. I just got today, in fact, just half an hour ago, from the institute, I got a post, and I got this book which says guidance note on non-compliances observed by quality review board during quality reviews, observations relating to CARO and IFC. So this is a very interesting book. I've just started, I was just opening the pages on what this book is. Similarly, there are two books that I think Mr. Lal, Anilji, aapne bheji hongi mujhe.
Yes, sir.
And the second one I got was a guidance on non-compliances observed by Quality Review Board, Volume 1, observation relating to engagement and quality control standards. So these two books are, I think, extremely valuable. We will all read through them, and we will learn on what are the issues that have come up in CARO. So let me, with that background, start with the first part of my presentation, and I will just share my presentation. First one. So we start with, there are 6, as Kunal mentioned: property, plant and equipment, inventories, internal audit, non-cash transactions, resignation of statutory auditor, and CSR. And this CARO, next page, again. So let's start with the applicability of CARO 2020. It applies to all companies, including foreign companies, except for banking companies and insurance companies. It does not apply to Section 8 companies, typically not-for-profit companies. It does not apply to one-person company or small companies. I will come back to this word small company again. It also does not apply to a private company who fulfills these four criteria, and these all four are cumulative criteria: that it has a paid up capital less than 1 crore, its borrowings, including current maturities of long term borrowings, are less than 1 crore from any bank or financial institution at any point during the current year, which means we don't have to see only the year end. And the revenue for the financial year, including other income, is less than 10 crores, including discontinued operations, if any, during the financial year. Now, these are the companies to which the CARO reporting does not apply. So we have to be very careful while applying or not applying CARO, that suppose we miss out anything and tomorrow it is found that CARO was applicable and we did not issue a CARO report, becomes very dangerous for the auditor. So please be very careful while applying these cumulative conditions. All four have to be fulfilled to give you an exemption. Let me come back to the word small company. I've been struggling with this since the morning today. That what the definition of small company, which is exempt under 285 of the Companies Act. So there's a 285, and then there's a rule 21T of the Company Specification of Definition Rule 2014, in which they have actually increased the limit. So if you read the Companies Act, there's a limit given under 285 on what a small company is. That limit has been enhanced under this circular to share capital of 4 crores and a minimum turnover of 40 crores. Maximum turnover, sorry, of 40 crores. So a company which has got a 4 crore turnover and capital and a 40 crore turnover can also be termed as a small company, and to which CARO will not apply. However, a private company where the capital is more than 1 crore, this CARO will apply. So we have to be very careful. In a small company is also called a private limited company, and a private company is also called a private company. So wait, how do we distinguish? So then I went a little bit detail on how do we determine that this is a small company. Then I went into Companies Act. So I found that every small company is required to file an annual form MGT 7A with the company as an annual return, as against a private limited company, which is to file a form MGT 7. So if you look at these two forms, then you will come to know whether you are a small company or a private company, and then you will be able to apply which exemption you have to take care of and whether CARO will apply or not. So I think this is a very extremely important part of applicability, and maximum number of people make a mistake in applicability of CARO itself. And this is Nikita, Kunal, anything you want to add to this?
Sir, I would just add, like, maybe from a practical perspective, when we were just like we audit our clients, you're absolutely right on the small company definition part. But where people sort of go, or in my experience, what I've seen people struggling with is that right at the outset, it exempts small companies. People try to check the private company limits and merge it with the small company definition to see whether CARO is applicable or not. So I think we have to be very clear in the standard, like, because I used to, like, I audited like an insurance company recently, and like this specifically excludes an insurance company, but people were sort of deliberating on CARO clauses. But it just, like, this is the first step, right? If you exclude, well, it's only then that you continue adequate reporting. So just one small input from my end. Small companies are excluded. For small companies, you do not need to check applicability of conditions that pertain to private limited companies. So these are two exclusive exemptions. That's sort of the value add from my end on this particular applicability clause.
Thank you, Baran. Nikita, anything you want to add?
Yeah. So I also feel that one-person companies are excluded, small companies are excluded, private companies are excluded. So while I was doing the CARO reporting, so people struggle with this small companies and private companies issue. They check the limits for private companies also, small companies also. So I feel that this CARO 2020 applicability is very important while doing the CARO reporting.
Exactly. So I think we are all on the same page. Be very careful
Yeah.
when you start the audit, when whether CARO is applicable, because if you miss out the applicability of CARO and you go through the whole audit, it's very difficult to go back and do all the checking again. In case at the end of the audit you find that CARO was applicable and oh, I missed out, then to do the whole audit again is very tough. So be very careful in determining, and this should be documented in your audit working papers. You should document how you arrived at whether CARO is applicable or not. In our office, I'll give you another practical example. In our office, there we have a checklist, which is interactive checklist. It says it has a yes and no. We fill it up. Every person fills it up, and then the engagement partner and the audit team signs off on it before the audit starts as a part of audit planning. So that's another suggestion that you can work with. Okay. Now we get into the discussion of the first point on property, plant and equipment and intangible assets, clause 318. Whether, again, this is the same clause which was there earlier with slight modification. This clause was there in the old CARO also and the new CARO also. Whether the company is maintaining proper records showing full particulars, including quantitative details and situation of property, plant, and equipment. Earlier, it was called fixed assets. Now the word is PPE. Whether the company is maintaining proper records showing full particulars of intangible assets. This is a new clause that is added here. Of course, everybody maintains, we go and check when we do an audit, we go and see a fixed asset register. We tally the fixed asset register with the company's books of accounts. Some issues that come up while doing that is in case of an Ind AS balance sheet, the new concept of ROU assets, which is right to use assets, where a long lease or financial lease is there and assets are created. Those are to be included into the PPE register and the fixed assets disclosures. Similarly, there are two other kinds of assets which sometimes people forget. One is investment properties, which also have to be included, and non-current assets held for sale shall also be considered by the auditor for reporting under this clause. What constitutes proper records and actually requires professional judgment by the auditor after considering the facts and circumstances of each case. But there are certain standard fields that must be there. There should be sufficient in the fixed asset register, with sufficient description of the item, the quantity. So this second word given here, quantity of the item, is very important. Suppose you have a description of item is chairs, you must have number of chairs. So the description of item is laptops of then you must have number of laptops. This is also given. I was reading this new guidance note on non-compliances, which I just mentioned. Here also they have mentioned in this particular clause of fixed assets that the auditor had not mentioned that the quantity was properly descriptively given in the fixed asset register, and that was deemed to be a fault in the CARO reporting. So quantity is very important. And while checking the fixed asset register, of course, we will see the asset head, the original cost, useful life, situation, rate of depreciation for the year, residual value, year of purchase, accumulated depreciation. So all these are standard items which are always there in a fixed asset register. We have to check these. Of course, we are also now in the new age where in the olden times we used to have, when I was doing audits, we used to have hard copy fixed asset registers. Now they are all maintained in soft form. But the soft forms fixed asset register, you have to see that there is a proper edit log, there is a proper way these are prepared. There should be a printout possibility of the fixed asset register. There should be a proper closure of the fixed asset register. There should be a backup of the fixed asset register. So in soft form, also these registers have to be properly prepared. And it does not mean they don't need to tally with the books of accounts just because they're in soft form. The full details must be there. And in fact, it's much easier now. In a soft form, you can do a Excel you can export the information to an Excel sheet and then total the figures and tally with your books of accounts. So it's actually become much easier to do. A lot of companies that we are auditing now have an interactive fixed asset register in the ERP form. And I think, Kunal, you also must be seeing the same thing in the US. In the US companies, these fixed asset registers are all now, they are part of the ERP system. They are not separately created. It's just a module. So when somebody buys a laptop, it automatically goes into a capitalization, it goes into a fixed asset register, it goes into an identification number, its residual value, year of purchase, everything gets logged in. So the new technology and artificial intelligence has helped us a lot in cross-tallying these fixed asset registers, and also the audit process becomes much easier.
Just to add that, sir, like you mentioned in the United States, yes, I think mostly people use QuickBooks there, but even in the Indian market, people are now integrating to the advanced versions of the SAP software, where you have PP modules, inventory modules. So absolutely right. Like we've moved on to an integrated model where all these things are now in soft and they're integrated with our accounting software, be it an ERP or an advanced module of SAP or QuickBooks, as the case may be.
So even I think I understand now Tally also has fixed assets module. So because I think half of India uses Tally, and for them, this is a very good module that but you have to pay for it and you have to integrate it. There's little effort required to integrate fixed assets into the accounting software itself, so that it is automatic. But it's worth that effort so that your books are automatically tallied, and the chance of mistake of human intervention is much less. The two issues which are ticklish in this is, of course, Ind AS 116, the leases where right of use is now capitalized, which earlier never used to be capitalized. So you have to pass entries for that, and it becomes, then if there's a capitalization in that leased out asset, then that capitalization also goes into the right to use. Then you have to see the useful life amortized over the lease period. So I got a query, in fact, today morning in one of my clients, which was being finalized, whether even if it is a long term is considered more than 1 year. So there was a lease which was only 18 months, and the company spent 20 crores on renovation of that flat to make it useful. So should we amortize 20 crores in the interiors of that flat over 18 months, though normally it would be amortized over a longer period? So even though there is a clause for renewal of the lease after 18 months, but if the lease is not renewed after 18 months, as an auditor, you cannot take a period more than 18 months for right to use. Kunal?
Interesting, sir. Once you asked that question, I was figuring out that question in my mind, like how would I approach it as an auditor? But yeah, because this includes, like you rightly mentioned, includes investment property. It's people limited their understanding maybe to this clause to only property, plant, and equipment. But I think the key pointer here is this clause extends to intangible assets. This clause extends to investment property. It also extends to the right of use assets. So yeah, maybe from like an input perspective on this clause, like the inclusions are very necessary. And yes, in like Ind AS 116 has always been a ticklish issue since its inception. So yeah, very, very valuable example.
So let me take one more example, which is not written here, which just come to my mind, is on intangible assets of software. There are various kinds of software that companies buy, application softwares and operating softwares. and you both are dealing with American companies. So you are dealing with both kinds of softwares that these companies are buying, which are custom made sometimes, or sometimes they're bought offline, online softwares which we use. So both these softwares are capitalized uh, in most companies. So Nikita, what's your view on this?
Yeah, so I've been working on ASC 842. So we have been capitalizing all these assets here. Yeah, so we do the ASC reporting Ind AS 116. We capitalize the asset here, ROU asset to lease liability. So I think both of these assets should be considered here under the intangible assets.
The issue that comes in is what is the residual life, useful life, sorry, of these softwares, because these softwares sometimes have a license. Then there's very easy. Whatever the license period is, you amortize it over the license period. Sometimes the license period is not defined, and you can it's a annual license, and you have to keep paying a fee to renew, right? Now, the software is huge cost. Obviously, if I paid 20 crores for a software, and it's actually used, it's being custom made for me, and I have paid 1 year's license fee, and I will pay a future, but there's no guarantee that I may not have the money next year to pay. So, do I take it as a capitalizable asset with more than 1 year life, or should I take it less than
More than 1 year, I think.
more than 1 year? Kunal?
I interesting, because yesterday I was just on, like, I just started auditing a new client, and the first thing I noticed on their P&L statement of operations was they had a line called expensed software, and that number was some $2 million. So I think in that case, what they've done is expense it off over that. They've not amortized it over the period of life.
So I agree with you that in case there is the useful life initially when I buy it is 1 year or less, sorry, less than 12 months, then I cannot capitalize
Right.
it. I must
Right.
amortize it, even though the amount may be useful to me, and the software may be useful to me beyond that. But till I pay
Right.
annual usage fee, I cannot capitalize that software. But where I've taken it for more than 5 years, for 1 year or 2 years or 3 years, then I will capitalize it and I'll amortize it over that. So this is again a very practical issue that is new to the new artificial intelligence world, but is coming in most large companies. So I'm sure there's no perfect answer to this, but yes, we need to deliberate a little bit more on this. Okay. Now we come to physical verification of the fixed assets. The responsibility of the physical verification lies with the company. The auditor's role is to satisfy himself that the physical verification was done. Adequate evidence to support the above conclusion exists and is there in our audit taken for the purpose of audit working papers. Examine the instructions issued by the management staff, uh, if not present when verification, if the auditor was not present while verification of the fixed assets takes place, because the assets could be all over India and you may choose to go to one or two places, you may not be present everywhere. Secondly, the verification is not necessary to be done only on 31st March. It could be done through the year based on the program that the company has made for verification. Thirdly, the verification of all fixed assets need not be done every year. It can be done in a phased manner where all the assets are covered at least once in 3 years. This is the guidance of the institute, and so that there's no difficulty in the companies getting it done, and that it is based on number of assets. But this once in 3 years does not apply blindly. Suppose the company has very few fixed assets, then the auditor can, and they're all in one plant at one place, the auditor is fully empowered to say, no, I would like the physical verification of 80 or 90% value to be done every year, and a report submitted to me. And he has also the right to be present when the physical verification takes place. He must take a copy or see all the documents that were prepared by the physical verification team. In fact, in our firm, we even issue a questionnaire to the physical verification team to ask them how they did it, what instruction they were given, what was the process that they followed. Because sometimes the companies say that followed a process, and the actual people who are on the ground who did the physical verification are not aware of the process at all. So this gap between the company's instruction and the team that was did the physical verification needs to be bridged by some intelligent methodology by the audit team, so that you are sure that physical verification is properly done. And then the auditor must exercise his judgment to determine that the discrepancy, if any, found are material or not, and how they have been dealt with in the books of accounts. This is the most difficult part, because fixed assets, if there's a shortage of fixed assets, you have to write them off. You need a proper approval from the management with those charged with governance. And in some companies, depending on their SOPs, even this goes up to the board, depending on the materiality of the amount. And the amount is large, we normally request the company to take a board approval for a write-off of the discrepancies, if any. Any questions till now?
Yes, sir. I have a question here. So one of my colleague was doing an audit in which the company was doing the physical verification in a phased manner, like once in 3 years. So he marked that reporting as non-compliant, but the branches were 8-9. So I explained to him that we can do it in 3 years. It is the guidance. So my question here is, suppose a company has 20-25 branches and it is not practical to do the physical verification in 3 years, and can they ask for a special permission to do it in 4-5 years if the quantity of the PP is very large?
Unfortunately not. This is the guidance of the institute, and 3 years is sacrosanct till the institute amends its guidance note. This 3 cannot become 4.
Okay.
Thank you. Should we go
Sir,
forward?
I have an input here and one question for you, sir. The input being, I was recently reading maybe a ruling or applicability that the NFRA, National Financial Reporting Authority, made on the clause. Like you rightly mentioned, it was basically a dispute between the internal auditor and the statutory auditor. The internal auditor mentioned in their internal audit report that the company has not undertaken a physical verification exercise, while the statutory auditor in the report had sort of certified that a physical verification exercise has been undertaken at reasonable intervals. And he represented to NFRA saying that it was a typological error, and it like the firm was found guilty. So that's just an input as to like the fact that if your statutory audit report or your statutory audit procedures are in deviation from what the internal auditor states, because like I mentioned, like today we'll be coming to the internal audit clause as well, where the statutory auditor is expected to take into consideration the internal audit considerations there, whatever the report says. So the auditor should basically, like in case of any deviation or dispute with the internal auditor, he should, like as per the SA 230 audit documentation, our documentation should support our sort of reporting. That's just the input on this clause, maybe on something that's going around in the market. The question, sir, the authoritative guidance says 3 years, and I was just like you mentioned, like it's not etched in stone. It could be like a year for a small company. So I just occurred to me that how does an auditor ensure safeguarding there? So let's say the company represents to us that they're going to like, okay, we have 2 locations, and it's impractical for us this year to cover both the location. Let's say hypothetically both the locations are very near to each other, and the management decides to do it in a manner of 2 years. But as per our audit judgment, they could have easily verified them in 1 year. And let's say the plan that they undertook this year, they could not cover the entire coverage as per the materiality that was determined in the audit plan. So how would we approach a situation like that in terms of reporting and safeguarding us and ensuring our documentation is appropriate as well as our reporting?
So as long as there is a plan by the management, there are 2 parts of it. One is a brand new company or a existing company which has a track record. So you
Right.
have to look at in a let me first take a company which is already existing. and has a 5-6 years history of doing business. And if they have been doing fixed assets verification in a systematic manner over a period of 1 or 2 years or 3 years, and they followed that process, and in one particular year, could be because of COVID, could be because of any other reason, they could not complete in 1 year, I would not make a negative comment on it. I would say, as long as we take a commitment from the company that they're doing it in this period, and in the second year, suppose they still don't do it and they don't
Right.
fulfill the commitment, then I would look at giving a negative comment. In a case of a new company that's just formed and they've just set up a plant, there I would definitely give a leeway to the company and give them a long rope to set up the processes of physical verification and checking. But I would then deploy my own team to check the major value of fixed assets, for example, plant and machinery. It's not that difficult to check plant machinery in 1 or 2 days.
Right.
So if
Right.
I find that the company has not done a physical verification, I would deploy my own team, send them to the plant, and get a verification done in 2-3 days of the major amount, because I must cover some reasonable amount of
Right.
value of fixed asset verification. In a 100 crore company, you can't say they cover 2 crores and I'm okay with it.
Right. Right.
That
Right,
answers
sir.
the question.
It does. It does. Thank you so much, sir. Thank you.
Then moving on to the next issue on PPE, which is again, this has come up in the new CARO on title deeds. I think the most vexed question, very difficult to check and report, and practically I found this to be very difficult to make the company agree to show title deeds of all land buildings, especially in old companies. These are normally either misplaced, not available, lying with the director, are in a locker. They are very reluctant to show it to you. I don't know whether you guys have faced the same problem ever. But
So this is the most this is like the first item on the PBC list, and
yeah,
this is the item that runs right throughout the audit procedures till the last day. And
absolutely.
I think the end answer is towards like a hard file locked up somewhere in a locker.
Yeah.
And like I did a client last year. The title deeds were in Marathi, so they're usually in other linguistic languages. So that's another challenge that comes up in this clause.
So we are supposed to check this. Of course, the not in the scope, let me first go to the not in the scope, is inventories of immovable properties of a real estate company are not covered here. The order is silent on what constitutes title deeds. So you have to use your practical knowledge and judgment to see what constitutes title deeds of these documents. And the complication also comes when there is a merger of companies, or a partnership is converted into LLP, or is converted into a company. The deed will be in the name of the old entities. It costs a lot of money to get the mutation done in the name of the successor entity, and so a lot of companies don't do that. So that you will have to disclose it here, that the deeds are not in the name of the company. You may give a reason that these are the names of the old company from which succession of the private limited company took place. And but this is a very normal thing in case of mergers and conversions that takes place. Of course, the issue will also be on right to use assets, where again you have disclosed this as an asset. You've taken land on lease. The land does not belong to you. The land is not registered in the company, never will be. But you've taken a 20-year lease on the land. So you have a right to use asset. So you'll have to disclose here that it's not in your name, and the reason you'll have to give here. So all these right to use assets will form a part of this particular disclosure. Nikita, you have a different view?
No.
You agree?
Yeah.
Now, so I am finding this is a very big issue in most companies for right of use assets, especially land and building, where a long list of asset goes which you cannot be in the name of the company. but we have there's nothing you can do but not disclose it. So this is an issue, and maybe the institute and the government of India and the company law board can look at it, and we can give a recommendation that whether these we can be exempted from giving them as a, because they serve no purpose by my writing that they are not in the name of the company, because they never will be. So maybe they can be deemed to be in the name of the company if the right to use a lease is there. So it's an issue which has always been on my mind, and I'm going to. I thought we'll take it up in various forums and maybe give a representation to the government for this. This is a practical suggestion for ease of doing business, which may help. Maybe Mr. Anilji can help in this. Should I go forward?
Yes, sir.
Now, the next one is on revaluation. This is also very interesting, whether the company has revalued its PPE, ROU assets, or intangible assets, or all during the year. If so, whether revaluation is based on a valuation by a registered valuer. So, registered valuer is the key word here. In the guidance note, also again and again, they have mentioned the word registered valuer. Then the second part of this is whether specify the amount of change if the change is 10% or more in aggregate of the net carrying value of each class of PPE or intangible assets. So it's the 10% or more of the whole class of assets. It's not just one single asset that has to be taken. This revaluation shall not include fair valuation of PPE upon first time adoption of Ind AS. When you first time adopt Ind AS, you have the option to take fair value, and that time you don't have to give a disclosure in CARO. Remeasurement changes that take place because of interest or foreign exchange rates changes, or change to ROU asset due to lease modifications as per Ind AS 116. So these three are exemptions to which are not treated as a revaluation or a change, which you do not require disclosure. Further, if a single item of PPE is revalued, then the whole entire class of PPE to which it belongs should be revalued. So suppose you revalue a piece of land, then you must revalue all the lands that the company has. You can't revalue a singular piece of land. And this applies not only to land, but to any other class of assets also. You have to specify the amount of change if the change is 10% or more in aggregate of the net carrying value of each class of PPE or intangible assets. So suppose the total value change in land is more than 10%, then you have to specify it. For reporting under this clause, will cover both upward and downward revaluation under revaluation model. So it's not just upward revaluation, it also covers downward revaluation. I try to find some sample reporting that people have done in this, and I found that the company has revalued its property, plant, and equipment, including right to use assets or intangible assets or both during the year. The revaluation was based on valuation by a registered valuer. The change of 10% or more in aggregate of net carrying value of each class of property, plant, and equipment or intangible assets on revaluation is as below. So then they're given a table. The class of PPE, nature of assets, net carrying value before revaluation, net carrying value after revaluation, and percentage change. So if the other parameters are fulfilled, this is you can use this table to give the disclosure in the CARO report. I don't have anything else that I need to add in revaluation. Any questions? Should I go forward?
Yes, sir.
We then come to another interesting item, Binami transactions. whether any proceedings have been initiated or are pending against the company for holding any Benami property under Benami Transactions Prohibition Act 1988 and rules made thereunder. If so, whether the company has appropriately disclosed the details in its financial statements. So, it's again a new clause, very difficult to implement. So a lot of it is it's digging. A lot of it is when the auditor wants to find out whether the company holds any property as a benamidar. I don't think you can go to the company and ask them that are you holding a company as a benamidar? They'll say yes, I am, and this is the property. I have never come across any such thing where the company is going to very openly admit to this. So you, as an auditor, have to apply your audit techniques. You have to apply your mind. You have to apply skepticism. You have to apply your all your tricks up your sleeves to find out if there's any benami property held by the company. One of the issues, which is also a guidance given by the institute, is if you look at the legal expenditures of the company, and it not only for this clause but for other clauses also, uh, verification of the legal expenses of the company to find out why those legal expenses were incurred, what were the cases that they've been paid for, the lawyers, and then in cases where you find any doubt, you engage, you have the authority to write to the lawyers and get information from them on the cases and the status of the cases for which they have been paid by the company. And there you may get a hint on whether there is any order of benami property against the company where the company is fighting a legal battle. The duty of the auditor is to find whether any proceedings have been initiated or are pending against the company for holding a benami property. Whether, and if so, if such a proceeding has been initiated, then the company should have appropriately disclosed the details in its financial statements. The auditor has to evaluate the consequential impact on the financial statements of the liability that may arise in case any proceedings under the Benami Act are decided against the company. The auditor also required to evaluate whether such liability is required to be disclosed as contingent liability or whether provision is required to be made. So it really depends on the seriousness of the matter. It depends on how much liability is likely to come to the company, what stage the case is at what level of court, and then, of course, like in any other matter, we have to jump between the two guns of contingent liability and provision. Whether you need to make a provision or a contingent liability, a claim against the company not acknowledged as debt is enough for a disclosure or not. And of course, in the notes of accounts, you will give proper disclosure of this case of a benami property, if any, held by the company. Only properties which are included under the head of PPE and intangible assets are to be considered as benami property. It is not, suppose it has stock in trade, which actually belongs to somebody else, is not included in this particular clause. You can also make, besides making inquiries for a management, obtain management representation letters and review legal expenses account, as I said just now. It may also be noted that reporting under this clause is limited to the adequacy of disclosure in the financial statement and to cases where proceedings are initiated with the company being treated as a benamidar. Reporting is not applicable where notice is reporting is not applicable where notice is received by the company as a beneficial owner and not as a benamidar. So if you have received a notice as a beneficial owner, so the difference between benamidar, whose owner is somebody else and you are only holding the company, the asset, or you are a beneficial owner of an asset and somebody else may be a benamidar for it. So the second part does not apply in this particular clause. So it's a very fine line that is drawn, and you need to I think in this particular case, if you find such a thing, it's better to take, as the institute recommends, an expert opinion from a lawyer on this particular aspect. Any questions?
So we usually audit the legal expenses to find if there is any liability that could arise due to the legal proceedings. But I haven't come under any case where the legal person informs us about the Benami transaction. Legal counsel informs us against the Benami transaction. So is there any other way we can get to know whether the company holds any Benami transactions?
It is basically when you look at if there, suppose the company does hold an asset as a benamidar, and somebody nobody can find that out unless somebody has filed a case. And this case, this guidance note also says in my second line of my slide, I've said whether any proceedings have been initiated or are pending against the company for holding a benami property. Unless any proceedings are there in any court, you cannot find out whether a property is benami property or not. So, and if the proceedings have been initiated, you will find expenses in the legal expenses list of the company. So that can be the only thing. And the third is, of course, you obtain a representation from the management. If they don't tell you give you a representation, you can't find the case, and there is no expense, then as an auditor, you are covered. You have no option but to say there's no benami transaction.
Yes. Thank you.
Thank you. So one sample reporting that we found on Benami transaction is according to which can help while framing the CARO report. Is according to information and explanation given to us, proceedings have been initiated or are pending against the company for holding any Benami property. No proceedings are pending under Benami Property Act as amended rule and under, and the company has appropriately disclosed the details in its financial statements. Schedule 3 of the Act requires the management to make the following disclosures in the financial statements of the company: details of such property, including the year of acquisition, amount thereof, details of beneficiary. Basically, what it is saying that the company is a benamidar, but the beneficiary of the property is somebody else. So here you have to give the names of the beneficiaries who are actual beneficiaries of that property. If the property is in the books, then reference to the item of the balance sheet. If the property is not in the books, then the fact has to be stated with reasons why it is not in the books. And I'll give you a small example. I came across very unusually a company once which had a property, a land, which was registered in its name in the land records, but was nowhere appearing in the balance sheet of the company. So this line that property is not in the books, there's no cost attached to the books, and the company is like a benamidar of that property, but the beneficial owner was the farmers who were tilling the land and were in physical possession of the land. So the company was a sugar company, and the was used to buy sugar cane from these farmers. At some point of time, they must have given them a loan which the farmers must have taken for the land and had taken the land as a collateral security. Many years ago, somebody, somewhere, some company employee went and got that land registered in the name of the company. The company never, that loan was repaid, so there was no cost. The beneficial owner was the land owner who were tilling the land. So it was actually a mistake why the land was in the name of the company. So that required a disclosure under this particular clause, and we gave the disclosure. And eventually, we also said that this was by mistake. The company has become a benamidar, and we have now taken steps to return the land and register it back in the name of the actual beneficial owners of the company. So this is a very vexed clause. This is basically has come from another way of looking at it is that there are companies which use this to circumvent the law. that they become owners of the land where the actual cost is paid by somebody else. There's no money going out from their coffers, but they're only holding the land on behalf of somebody else who may be a non-resident, who may be under a scanner, and they don't want to hold lands in their own name. So they hold it in the name of a company, and so the company becomes the benamidar while the beneficial owner is somebody else. So it's extremely difficult to find it till there is actual some government authority finds it and issues a notice to the company under Benami Property Act. But this is the disclosure under Schedule 3 that they have to do. Moving on to the next issue after PP is over now. So we go to clause 3(2)(a) on inventory and working capital facilities. Again, a new clause, very, very difficult to manage, very, very difficult to report on, and takes a lot of effort and how should I put it? A lot of effort and fights with the client, between the auditor and the client, and maximum number of arguments take place on this issue because to have very accurate data between what the company gives to the bank and to tally it with the company's records, especially in companies where which are unlisted companies, where quarterly balance results are not prepared, is a Herculean task. I don't know whether both of you ever came across such a thing.
So I came across a situation where a company was filing the quarterly returns and they reported the debtors incorrectly to the bank
Yes. So
in the quarterly returns. So what do you think? Should we consider materiality while dealing with the amount that was wrongly reported?
yes. So I've written here, if you come see that slide, discrepancies, materiality threshold for the auditee is not relevant. Reporting is required if the discrepancy is 10% or more in value. So the institute itself has given, and the Companies Act itself has given the materiality level. So up to 10% of discrepancy you can ignore. So if the discrepancy is more than 10%, sorry. This is for fiscal year. Sorry. I'm sorry. I was talking about the next one. Let me go there first. I'll come back to this one. Yeah. Reboot. I'm going to look at this clause again first. Whether at any point during the year the company has sanctioned working capital limits in excess of 5 crores in aggregate from banks or financial institutions on the basis of security of current assets. Whether the quarterly returns or statements filed by the company with such banks or financial institutions are in agreement with books of accounts, if not, give details. So here you are right, there is no monetary limit prescribed. The 10% was in the physical verification of inventory. Here you have to exercise a judgment, whether based on materiality of the company, whether the discrepancy is material in nature that you need to give or not. So let's say, for example, 100 crore company has got a bank limit of 5 crores and it has debtors of, let's say, 6 crores, and it gave a list of debtors of 5.8 crores. Would you disclose that there's a difference of 20 lakhs? I would think you would first go to the materiality calculation that you have done in the company, because you do a 3-tier materiality calculation when you make your audit program. Based on materiality calculation, you can apply that to this clause also, that based on your materiality level that you have done, does it fall below or above that materiality level? And if it falls within that, you can ignore it. If it falls above, you can give a disclosure.
So do I need to report that since it was falling below the materiality, so it
no, you don't
doesn't
need to
not to be qualified?
No, you don't need to qualify it. You can say that the difference, if any, is not material.
Okay.
You can just write a line that not material is what you have. It's your judgment,
Right.
and that materiality level is also judgmental based, because you have calculated a judgment materiality. You could have calculated materiality on turnover. You could have done it on assets. There are different ways of calculating materiality also. So
Right.
so you have to exercise the judgment whether that materiality is enough for you not to report it or report it. But you don't have to say that it is below my materiality level, therefore I'm not reporting it. I
Got
don't
it.
think that's required.
Thank you.
Now, the problem will be, of course, where the stock statements and others are not there on a quarterly basis, because the uh, company does not prepare results on a quarterly basis. So you have to insist that the company gives you quarterly balance sheets, quarterly stock statements, quarterly from the books, the debtors, creditors, because you have to calculate the working capital gap and check that with what they've given to the bank to calculate their drawing power limits. And it means that a company which which has a more than a 5 crore sanctioned limit or utilized limit, sorry, will have to prepare quarterly results for you to check that. So it automatically becomes incumbent on the company to make monthly or quarterly results for you to be able to report on this clause, just like a listed company. So unlisted companies are now forced to make quarterly results, and I have been insisting with most all my clients that they start preparing quarterly results like listed companies, which gives me also and the company also much better audit trails. With now the new clause of audit trails has come in, there's much better control over accounts. There's much more transparency, much better corporate governance in all methodologies. Is good for the promoters that they come to know what the results are on a monthly and a quarterly basis rather than looking at it on a year end. And most of my clients have agreed to do it. And in the last 1 year, we've nearly implemented this in all 100% cases, where now quarterly results are being prepared, even in unlisted companies, for us to be able to report on this clause. So extremely important and extremely good clause that the government of India has implemented, and it has tightened the control over companies itself and in the running of the companies.
Sandeep sir,
Yes.
we're just receiving certain questions from the audience, so I was just thinking it will be valuable to sort of have your time utilized to responding to some of the questions that I'm receiving. So
Yes.
somebody's asked that how do we tackle a situation where the reporting, the quarterly statements that we submit to the bank and the underlying books, whether there is a material let's say a material difference does exist. So how do we tackle it in our reporting, in our CARO reporting, and in our financials? Do we prepare like a reconciliation, give a disclosure in the footnotes in the financials, or do we give adverse CARO reporting?
So this will become a adverse CARO reporting. And this particular, there's no need for any footnote. There's no Schedule 3 requirement. This reporting will go in CARO itself.
Okay.
And if the company wants, because the notes to accounts belong to the company,
Right.
if the company wants to give an explanation, it is open for the company to write in its notes to accounts what their issue was. Suppose they have an explanation, they have a problem, there were some floods, there were some issues why the stock was given. Or sometimes, you know what happens, companies give stocks which are based on market value to the banks, and the books carry the stocks at this is the biggest most common issue difference that I found. The books carry stocks at AS2, cost of goods, and the banks sometimes are given stocks based on market value, MRP, so that they can do a higher MRP limits drawing power. So So it's MRP minus GP is a standard old Indian style of giving stocks. That does not tally. So the
Right.
company can give an explanation that we have a different methodology of valuing of stocks at cost while we give it to the
Right.
bank, which is traditionally done, and they can explain it in the notes to account because notes belong to them. But
Right.
if they do that, then you as an auditor must give reference to that note in your audit report. You have to refer to that note.
Right.
Any other question?
I think we can move on, sir. I think we move on to the next.
So there's one sample reporting that I have found on this clause. According to the records examined by us during the year, working capital limits in excess of 5 crores in aggregate have been sanctioned to the company by the banks on the basis of scrutiny of current assets. According to information explanation given to us, the quarterly statements filed by the company with such banks are not having any material difference. I think this will answer your question, Nikita. Are
Yes.
not having any material difference with the books of accounts of the company of the respective quarters, and those differences are of explainable items in and are in nature. Refer note 36 to standalone financial statements. This answers Kunal the query that we've got. The company has not been sanctioned any working capital limit by any financial institutions. So it's just lucky that this particular clause that I found, this is again, I picked up from public domain. CARO reporting for March 23. So this answers both these questions on materiality and note given by the company on the difference between the two. There is no material difference. Another one was, according to information and explanation given to us, the records examined by us during the year, the company has not been sanctioned working capital limits in excess of 5 crores in aggregate from the banks or financial institutions on the basis of security of current assets, except some facilities which have been sanctioned in excess of 5 crores against security of fixed deposits. So this is again I picked up because our own office had this problem that there's a 5 crore limit. It's not against debtors and working capital. It's a working capital limit, but the working capital limit is against fixed deposits. Now, there are no debtors, there's no inventory. How do we report it? So then we reported this in this manner, that we gave a disclosure that there is a 5 crore limit, but against security of fixed deposit, where the submission of quarterly return and statement not required. Accordingly, provisions of clause 3(2)(b) of the order are not applicable. So this can be, there could be a situation where there is a borrowing, but you are not giving the borrowing against your inventory and working capital. So I think I skipped one clause. I'm going back.
I think it's 2A, sir.
Yes. Inventory and working capital facilities. Whether physical verification of inventory has been conducted at reasonable intervals by the management, and whether, in the opinion of the auditor, the coverage of procedure for such verification by the management is appropriate, whether in discrepancies of 10% or more in aggregate for each class of inventory were noticed, and if so, whether they were properly dealt with in the books of accounts. Now, this is similar to the physical verification of PPE, that but here the issue is that physical verification has to be done every year. This is not a 3-year interval issue. It has to be done at reasonable intervals depending on circumstances of each case. Following factors have to be considered by the management: periodicity, nature and location of inventories, feasibility of conducting physical verification. Material items of inventory should be verified by the management at least once a year for a ABC classification. Appropriate, what constitutes appropriate is a matter of professional judgment. The coverage and procedure of such verification shall be reasonable and adequate in relation to size of the company and nature of its business. While the physical verification of inventory is primarily responsibility of the management, the auditor is expected to examine the methods, procedures, and coverage of such verification. So these three words are very important. That what is the responsibility of the auditor is to examine how the physical verification took place, what are the procedures that the company has undertaken, and what was the coverage of such verification. Discrepancies is we have a 10% threshold tolerance limit of any class of inventory. This 10% threshold for reporting must be applied on a net basis after adjusting excess and shortage of within the class of inventory. If such discrepancy results in net excess of 10% for any inventory, reporting would still be required, even if inventory. So some people feel that if the inventory is more, then I don't need to require to report. Yes, it still requires reporting. Now, adequacy of physical verification. Again, here 100% physical verification is not a requirement of law. If you do a ABC classification and you find that A category you have verified all the items, B category you have verified let's say 75%, and C category you have verified 50%, and the overall you have covered 80% of the inventory in physical verification, I think that is adequate verification. It also depends on the nature of items. If there's a continuous processing industry, for example, there's a company that we audit which does uh, processing of edible oil, where the oil machinery does not stop at any point of time. And there they have these bins, so they do a dipstick check every 3 months, and so we do an average dipstick check, and we check nearly on 31st March, near 25th, what is the dipstick, 30th, what's the dipstick, second, what's the dipstick. So depending on the possibility of the coverage, the verification is done. There's another company which deals in food grains, which is seasonal. So they do a check of inventory on seasonal basis where the inventory is the highest. So we insist that they must check do a physical inventory at the peak time and at the lowest time, so that we know that there is proper adequate record keeping of inventory. So again, inventory need not only be done on 31st March, it can be done through the year also, as long as the process gives you comfort that the figure given as on the closing of the year has adequate backup and is accurate, and is tallying. The physical verification is a way of tallying with the books of accounts, whether the books and the physical stocks tally with each other. So it's again a question of reasonable judgment, to apply reasonable skepticism by the auditor, and to see whether the result is clear and unambiguous and is accurate.
Sir, I had a question on this, Sandeep sir. Uh, if and pretty much following on the same question on the PP, but we had like a authoritative guidance from the institute on the 3-year plan. If a client does 50% of the physical verification and does it without having regard to the ABC analysis, what would that attract in terms of CARO reporting as an auditor?
So let me read this again. Whether physical verification of inventory has been conducted at reasonable intervals by the management, and whether, in the opinion of auditor, the coverage and the procedure for such verification by the management is appropriate. So I would then consider that the coverage of the verification is not appropriate. So if we have covered only 50% inventory in the whole year without a ABC analysis,
Right,
I would not consider that appropriate.
right. Thank you, sir.
Sir, I have a question from the audience.
Yes.
In case of a PSU, if the title deed of land is in the name of state government, the company will receive only the possession letter for government, which is not yet received, whether reporting in CARO is required.
Yes, it is. Because in any case, suppose the land is capitalized in the books of the company. Because in PSUs, you will find a lot of cases the land is never capitalized in the name of the company. It is always held by the government of India, and a right to use is given free of cost. So you don't even have a ROU. I faced this in one PSU that I was auditing. The company was doing a business of laying railway lines for railways. All the land, as you know, belongs to the railways and the government of India. That land is never given to the company that lays the railway lines. But they set up a shed. They did everything, and on the land they were given unlimited use of the land. It was not capitalized in the books. So I gave a disclosure uh, in the CARO reporting that the company has this piece of land, which it is not in the name of the company, that is not capitalized in the books of the company, and there are no ownership rights in the company and belongs to the government of India, and therefore there are no title or deeds of the land. So it's always better to, especially in the case of PSU, because then there is a CAG audit that takes place. And in fact, I got a letter from CAG on that particular clause that you have not given adequate disclosure. You should have also written that the land is in possession of the company and is on long-term use by the company, and given more details. So in case of PSU, we have to be very careful, because the land will never belong to the company. The land title will never be in the name of the company. It will always belong to the President of India. So you must give full disclosure. I hope that answers the question.
Yeah.
I face this problem. Can I go forward?
Yes, sir.
So we come to clause 314B on internal audit. How to say that this internal audit, according to me, is again aspect which is a lot of times ignored by the management, purely because there's a cost attached to it. So if the company has to get a proper internal audit done itself, it requires to set up an internal audit department. If it gets outsourced to an outside company, again, there's a cost attached to it. So a lot of companies shy away from getting a proper internal audit. Therefore, this clause has now been introduced. It's a new clause that whether the company has an internal audit system commensurate with the size and nature of business. This requirement has been reinstated from CARO 2023. Whether the reports of internal auditor for the period under audit were considered by the statutory auditor. So this clause requires a comment on the internal audit system, whether commensurate with the size and nature of the company. Key considerations are applicability of this clause, nature, timing, extent of work performed by the internal auditor, and its communication with those charged with governance is extremely important. So you have to see whether the internal auditor is an outsider or insider. Does he have the power to communicate with those charged with governance, or he only reports to the CFO, and the CFO then tells him to water down his report and does not bring in the important issues before the people, the board of directors and the managing directors, and the issues never are rectified. So this issue that the statutory auditor must see is whether the communication is there between the internal auditor and the people who are charged with governance of the company. The procedures to be performed by the statutory auditor with respect to the work performed by the internal auditor are that he must look at the audit program, see whether the audit program is adequate, and consider all the observations of the internal auditor, and whether to see whether they have any financial impact on the financials of the company. The new internal financial controls on financial reporting report under section 143(3) that now the auditor has to give is now closely linked to the internal audit report. So if there are any deficiencies pointed out by the internal auditor in his report, the statutory auditor has to then necessarily look into those issues while framing his IFCR report and see whether he needs to qualify any of the clauses on the internal financial controls reporting or not. So the two become interlinked. The internal control, the financial reporting, and the internal financial controls. The internal audit plan has normally is to be agreed with the management and the statutory auditors at the beginning of the year. The engagement letter should specify the areas to be covered and for the financial year should be made available to the statutory auditors. The statutory auditor actually is also entitled to look at the draft reports issued by the internal auditor and see how the issues have been closed, the follow-up reports issued by the internal auditors, and what action the company has taken on each of the issues raised by the internal auditors. All audit reports have to be, of course, made available to the statutory auditors in advance. I'm giving one sample reporting that some company has done on internal audit, which is, in our opinion, the company has adequate internal audit system commensurate with the size and nature of its business. In this particular case, the company had its own internal audit system and did not give the internal audit work outside to some outside CA firm. It was doing it internally. And it also said, we have considered the internal audit reports for the year under audit issued to the company during the year and till date in determining the nature, timing, and extent of our audit procedures. So even while framing, so this last line is very important, that even while framing the audit procedures, the audit program, the statutory auditor will take into account that what the internal auditor has done, what his audit program is covering, and based on that, the statutory auditor can increase or decrease his areas of coverage. I think that's the major issues on internal audit. Any questions?
So no question, just an input. So
Yes.
while we were doing CARO reporting in our company, so we used to thoroughly read the internal audit report and specifically where the internal auditor has presented any non-compliances. So it was very important. So we used to take that in consideration and then report according to that in different clauses.
Yes, absolutely. So you did absolutely the right thing, and that's, I think, what is required by law. And we, as a statutory auditor, the reading of the internal audit report and making adequate disclosures in your audit report based on the internal audit report is extremely important. We go to the fourth issue of the today's presentation. Are we on time? Yes, 5:35. So on non-cash transactions, this again is a new clause on whether any non-cash transactions with directors or persons connected with him. So there are two parts of this, huh? Directors or persons connected with him were entered into. If yes, whether provision of section 192 of the Companies Act have been complied. So there are two parts of this clause. The auditor needs to report whether the company has entered into any non-cash transactions with the directors or any persons connected with them. Firstly, if such a transaction is there, a non-cash transaction with directors or a person connected with them, the auditor then needs to report whether provisions of section 192 have been then complied. Now, what is section 192? Section 192 deals with the restriction on non-cash transactions involving directors or persons connected with them. The section prohibits the company from entering into the following types of arrangements. An arrangement by which a director of a company or its holding company, subsidiary or associate company, or a person connected with said director acquires or is to acquire assets for consideration other than cash from the company. So, if the director or his subsidiaries or associate or a person connected to them has to acquires an asset from the company other than cash, then it is very difficult to say what kind of asset. I've been thinking what kind of how can a company get a non-cash asset. One example came to my mind is that a company owns a residential flat. It's a company engaged in manufacture of some goods. However, it also has some flats which it keeps for its employees near the factory, because we've got a factory outstation near a outside main town. If some of these flats are then given without any consideration for use by the directors or its associate or subsidiary companies or a persons connected with him without any consideration, then this would be a non-cash. This would fall into this category of non-cash transaction with the director. Or the company owns a house on, let's say, a posh colony, and the director goes and lives in that house and pays no rent for it. It would be a non-cash transaction. There will be no entry in the books of accounts, but the asset is being used by the director. So this will be again a non-cash transaction, which is violative of Section 192 of the Companies Act. So just two examples came to my mind where these assets, this transaction can be covered. An arrangement by which the company acquires or acquires an asset for consideration other than cash from such director or person connected. So this could be another example by which the company acquires or is to acquire assets for consideration other than cash from a director. Arrangements can only be entered by the company on fulfillment of the following condition laid out number 92. Now, this kind of arrangement can also be done. However, you need prior approval of the company in its general meeting by the shareholders. When you go through the process of a general meeting, there has to be a explanatory statement. The shareholders have to be informed. The shareholders have to pass a special resolution that will be filed with the registrar. So once you do that, then you can do a transaction, which is a non-cash transaction with the director, but it's a related party transaction. But you have to follow the process of getting approval of the shareholders of the company for doing this transaction. And of course, the shareholder will never give an approval unless it's on an arm's length basis, and on a fair way. Now, what are the transactions which are not considered as non-cash transactions? Acquisition. If the acquisition of asset takes place in 1 year and corresponding settlement is made in the following year, then the said transaction will not be considered as non-cash transaction for that year. Further, mergers under court scheme would be entered into subject to requisite approval of courts and would not be considered as non-cash transactions. For reporting on the first part of this clause, the starting point of the auditor's procedure would be obtaining a management representation as to whether the company has undertaken any non-cash transaction with the directors or persons connected with the directors. The auditor would need to collaborate the management representation with sufficient audit evidence. A scrutiny of the following books of accounts, records, documents could provide some source of audit evidence to the auditor. Form MBP1, which is a notice of interest by the director. MBP2, register of loans, guarantee, security, acquisition made by the company. Form MBP4, register of contracts with related party. Movement in property PPE register. Minutes book of general meeting and meeting of board of directors. Reports available in public domain which are to be substantiated from the company. The second part of this clause is reportable only if answer to one is affirmative. So the second part of the clause is where you are talking about whether 192 is complied with or not. So first, there has to be a non-cash transaction. If there is so, then you have to see whether 192 is applicable or not. Now, persons who are connected with the director is not defined anywhere. So again, here we have two clauses under the Companies Act which give us guidance. The persons connected with the director can be taken firstly from section 185(2), which says any persons in whom any director is interested is defined under 185(2) of the Companies Act. And then there's a section 277 of the Act which defines relative of a director. So both these sections can you can take these two sections, make a list of all the people, look at the notice of interest by MBP1, and then combine these three things together to know who are the persons who are covered under the definition of directors and persons connected with the director, and then see if there are any transactions made with them which require approval under section 192 of the Companies Act. Some sample reporting under this section which we found. The first one was, according to the information explanation given to us, the company has entered into a non-cash transaction with one of the directors, persons connected with the director during the year, by the acquisition of assets and or assuming directly related liabilities, which in our opinion is covered under section 192 of the Act, and for which approval has not yet been obtained in the general meeting of the company. In case the said non-cash transaction are entered into by the company after obtaining prior approval of the shareholders in the general meeting, then such factual position giving detailed approval must be disclosed. So the first part we have given. The second part is that if they have taken approval, then we must also give the factual position that they have been taken approval. In case there is no non-cash transaction, then according to information explanation given to us, in our opinion, during the year, the company has not entered into any non-cash transaction with directors or person connected with the directors, and hence provisions section 192 of the Companies Act are not applicable to the company. Any questions on this clause?
So one question from my side. If we notice the language of this clause, it also includes to acquire. It not just it doesn't limit itself to like the company entered into a non-cash transaction. It also includes whether the company is to acquire. So
That's
in a
right.
case where before the date of the audit report, but after the date of the financial statements, the company enters into a transaction to, let's say, acquire a non-cash asset from one of the directors, and that is evidenced by, let's say, minutes of subsequent board meetings. Like we ask for subsequent board meeting minutes as part of audit procedures on as governed by the standard on subsequent events. So that would still form a part of our CARO reporting, right? That transaction that's post year end, but before the date of the audit report.
I don't think so, because if post year end would come into the next year's CARO reporting, and you would have to get a prior approval, because then there's time for approval by the shareholders. So suppose your year ends on 31st March, and there's approval by the shareholder given in April, and post that they are going to acquire, then it's fine. Then if they don't take that, then the next year's auditor report will give the approval, will give the disclosure. Till 31st March, because this act, this particular clause is relating to this particular financial year. It does not look at transactions beyond 31st March, unlike the other clauses where events occurring post balance sheet are also to be taken into account. This is my view.
Okay. Thank you, sir. Thank you.
This is quite a simple thing. I think everybody knows this resignation of an auditor. This is now governed by both Code of Ethics and also by the guidance note of the Institute on resignation withdrawal from an engagement to perform audit statements is issued by the Institute. We can no longer say that I don't want to continue as an auditor because I'm busy. I can. We have both the auditor and auditee. We have both agreed to change the auditor, so we are resigning. and they're free to appoint somebody else. There has to be once you are appointed for a particular period, you hold office till that period. It's a very serious appointment. You can only leave if there's any serious reason, and then you have to explain that reason in the resignation letter itself. And the new auditor who's appointed to fill the casual vacancy caused by the resignation of the auditor must communicate, as we know, with the auditor to see whether there is any reason for him not to accept or not to accept the appointment. So all those are processes that we've been always following. There's nothing new in that. And the what is not applicable to this particular clause is the rotation of an auditor after his appointment expires, resignation by a joint auditor, modification in the last opinion issued by an outgoing auditor considered in NOC, issues or objections or modification not to be reproduced. It means that whatever the objections are, concerns are raised by an outgoing auditor need not be reproduced by the incoming auditor in his audit report. We normally give a EUM when I'm taking over an audit of a company that I have not audited the previous year figures. I'm sure you both must have also given them in some companies where a change of auditor takes place, and any other evidence identified a reason for resignation of the new auditor. But however, if you come to know of any serious issues which the auditor points out, then of course it is your duty to then investigate that while doing your audit. And if that leads to a qualification or a modified opinion, then so be it. Then it will come into that audit report. I think this one is quite simple, and I think everybody knows this particular clause quite well. Of course, there's a process. You have to file a ADT3. Annexure A has to be filed in case of listed companies, NOC from outgoing auditors, letter representation from the management, board minutes, communication with those charged with governance for the outgoing auditor, sample reporting. Sorry. There is, in case of a resignation of auditor during the year, there has been a resignation of statutory auditor during the year, and we have taken in the issues, objections, and concerns raised by the outgoing auditors. In case of no resignation, there's no resignation of statutory auditor during the year, and accordingly, this clause is not applicable. So, in this clause, there are two kinds of reportings that we can do. Okay, now we come to the last point of today's discussion on CSR. I think the most it's a new clause. CSR is very widely discussed, very commonly discussed issue, and the particular clause that we are dealing with here is extremely important, whether in respect of other than ongoing projects. There are two kinds of CSR projects that a company can do. One is ongoing projects, and one are projects which are not ongoing but are going to be done in the future. So first, let's look at whether in respect of ongoing projects during the year, the company has transferred unspent amount to a fund specified under Schedule 7 to the Companies Act within a period of 6 months from the expiry of the financial year in compliance with second proviso to subsection 5 of section 135. This clause requires the auditor to comment whether the company has transferred the unspent amount in respect of other than ongoing projects to a fund specified in Schedule 7 to the Companies Act within a period of 6 months from the expiry of the financial year in compliance with second proviso to subsection 5 of section 135 of the Act. The auditor needs to evaluate the applicability of section 135. The auditor needs to obtain a board approval of CSR policy as recommended by the CSR committee, agenda and minutes of CSR committee, the workings of the amount required to be spent under Section 135 of the Act, detailing the calculation of the average net profits according to the provision of Section 198. So I think this is most important. And 130, that the CSR expenditure is actually based on the preceding year's figures. So during the year, as soon as the preceding year's audit is over, you know what is your current year's liability as you calculate your profit under Section 198 of the Act. Once you know that liability, then you see whether there are any ongoing projects or other than ongoing projects, and where the money is going to be spent. And that actually decision is again not of the management, it is of the CSR committee. So you have to go into the minutes of the CSR committee. So actually your work is all done by the CSR committee. The auditor will obtain confirmation from the management and review whether the CSR activities undertaken by the company are in accordance with Schedule 7. Schedule 7 gives a list of activities. The auditor should obtain from the management detailed amount spent in respect of projects other than ongoing projects. In respect of the amount spent, the auditor should examine the supporting documents such as expenditure receipts, bank statements, etc., to verify the quantum of such expenditure. So we are here talking about other than ongoing projects, where we have to see what are the amounts spent, and whatever is the, suppose the liability is 100 rupees and there are no ongoing projects and you spend nothing. Then at the year end, within 6 months, you have to open a special bank account and we have to deposit the money into that bank account as per Section 135(5). Right? Yeah. The auditor should also verify if the amount spent is in accordance with the CSR policy of the company and in accordance with the provisions of the Act and rules made thereunder. On the basis of verification of the amounts, the auditor should further verify that any unspent amount in respect of other than ongoing projects has been transferred to a fund specified in Schedule 7 to the Act within a period of 6 months of the expiry of the financial year. The auditor shall check whether the company has recorded a provision as at the balance sheet date to the extent considered necessary. Sample reporting. In respect of other than ongoing projects, the company has transferred unspent amount to a fund specified in Schedule 7 to the Companies Act 2013 within a period of 6 months of the expiry of the financial year in compliance with the second proviso to subsection 5 of Section 135 of the Act, except here it's exception reporting that the company did not, if the company did not deposit the amount, then you say except the following. For the current year and for the previous year. Now this table has to be given both for the current year and for the previous year for which the amount remains unspent. Auditor should also report under this clause non-compliance, if any, in respect of any earlier financial year in the format given above. In case you have there is no non-compliance and the money is deposited, then we have to give that the company has complied with this clause and has deposited the money in the specified account. Now, the second part is whether in respect of other than ongoing project, the company has transferred the unspent money amount to its fund specified in Schedule 7 of the company that within a period of 6 months of the expiry of the financial year in compliance with the second proviso of subsection right, sample reporting, where the time specified under sub provision of subsection that has not yet elapsed at the time of issue of the auditor's report. So suppose you are issuing the auditor's report in July and you had time up to September, 6 months to deposit the money. The auditor should report under this clause on the basis of information till the date of his auditor's report. A sample of this auditor's report may be as follows. The company has not transferred the amount remaining unspent in respect of other than ongoing projects to a fund specified in Schedule 7 to the Companies Act till the date of our report. However, the time for transfer, that is 6 months of expiry of the financial year as permitted under second proviso to subsection 5 of section 135 of the Act have not yet elapsed till the date of our report. So, in case the time is not expired, you can do that. Suppose he is deposited, you say deposited. Suppose he is not deposited, then you say they have not deposited. So, this is for other than ongoing projects. Now we come to whether the amount remaining unspent under section 135(5) of the Act pertaining to any ongoing projects has been transferred. So, there's a distinction between ongoing projects and projects which are other than ongoing projects have been transferred to a special account in compliance with provision section. Now, here is 135(6) of the Act. This clause requires the auditor to comment whether the company has transferred the unspent amount in respect of any ongoing projects to a special account within a period of, here the period is 30 days from the end of the financial year in compliance with provision subsection 6 of section 135 of the Act. Unspent amount of for any ongoing project undertaken by the company in pursuance of CSR policy shall be transferred by the company within a period of 30 days from the end of the financial year to a special account to be opened by the company in that behalf for that financial year in any scheduled bank called unspent corporate social responsibility account, and such amount shall be spent by the company in pursuance of its obligation towards CSR policy within a period of 3 financial years. So here the government gives you 3 years. You deposit the money within 30 days from the end of the year into this account. And then in 3 years, you can use the money for your ongoing projects. Failing which, if the 3 years are expired and you still have not spent the money, the company shall transfer the same to a fund specified in Schedule 7 within a period of 30 days from the date of completion of the third financial year. Here again, the auditor needs to obtain board approval of CSR policy as recommended by CSR committee, agenda minutes of CSR committee, workings of the amount to be spent under section 135 of the Act, dealing with calculation of average net profits in accordance with section 198 of the Act. Now, whether any amount remaining unspent under section 135(5) of the Companies Act pursuant to any ongoing project has been transferred to a special account in compliance with section 130, subsection 6 of 130 Act, the auditor is required to review the CSR activities undertaken by the company in respect of Schedule 7 of the Act. I think I've covered all this. Let's come to sample reporting. In respect of ongoing projects, the company has transferred unspent CSR amount as at the end of the previous financial year to a special account within a period of 30 days from the end of the financial year in compliance with provision of section 135(6) of the Act. In respect of ongoing project, the company has, in this case, not transferred the unspent CSR amount to the as at the balance sheet date out of the amounts that were required to be spent during the year to a special account in compliance with provision subsection 6 of section 135 of the Act till the date of this report. Since that time, the period of such transfer, 30 days from the end of the financial year, has not elapsed till the date of a report, or you can say it has already elapsed. So both these reportings can be done. Okay. So we have covered everything. Any question on CSR?
One question from my end. Have you ever encountered this, very curious to know, encountered a situation while doing your audit clients when a particular expenditure is disputed in terms of whether it would qualify as a CSR spend by the auditor while it is being represented by the company that it is CSR spend? Ever sort of encountered something like that?
Every day. Every day. So this is a very, very, very common problem. I'll give you an example. There is a company which spent money on holding on setting up a eye clinic in its factory. and the eye clinic was used for eye testing and operations, not only for its mainly for its employees, their families, and also for the villages around the factory. And they said this is CSR expenditure. So is this CSR expenditure? What's your view?
Nikita, you want to take that?
So yeah, it is a CSR expenditure. I think so.
So it is not, because the CSR says
Okay.
that the money should not be spent for the benefit of employees or their families.
Okay.
Your CSR has to be for third parties. If I am doing, every company wants to, is anyway doing medical benefit to its own employees. If that was allowed, then no company would ever do any CSR expenditure outside the company.
Right.
Every company would suppose I have 5,000 employees. I will anyway have under Factories Act. I'm supposed to have a medical facility. I'm supposed to give medical relief to my own employees. So by giving a medical facility to my employees, to doing their polio vaccination, to do their eye testing, to do their dental testing, I'm only benefiting myself, because I'm only, my employees are happy. I'm doing some activity for them. This is not really a CSR activity for the public in general. CSR has to be for general public, not that only benefits me and my company.
Right.
It is, the CSR guidelines are very clear. It must be not for the benefit of my employees or promoters or directors or shareholders. Even if they do it for shareholders, wrong.
Sir, but if it is jointly done for the employees as well as the
It's
common
very,
people,
then it's very
other
difficult
people.
to say what part of it is for them. So they have said no, this expenditure where employees are also benefiting are not considered as CSR expenditure. And CSR guidelines are very clear on this. There are FAQs also on this.
Okay.
But I'm very glad that this initiative was taken by the government for CSR, and you can see all over the country now. You see CSR initiatives being undertaken for medical and for benefit, cleanliness, toilets, and with the Modi
Yes.
government, lots of issues, benefits have been given to public at large, which were earlier limited to companies and their employees also. So actually, this is a fantastic initiative by the government.
Yes. Yes.
Sir, I also have a question from the audience
Yes.
on non-cash transaction. So if a company pays to acquire a car and record it in its books of accounts, but register the car in the name of the director, then is it a non-cash transaction?
If the asset is registered in the name of the director, but the asset is used by the company and it is in its PPE, it is in its fixed asset register, it is not a non-cash transaction. However, the company cannot claim depreciation on an asset which is not registered in the name of the company. There is
Right.
no problem claiming depreciation. It depends on, is it for use of the director or not. So it is
Right.
merely a registration in the name of a director is not a ultimate test. The test is who's using that car.
Okay. I have one question related to PP.
Yes.
One of our client expensed out fixed assets having value below $5,000 as per their group policy. How to go about physical verification in this case? Whether assets which were not capitalized being below threshold should also be physically verified?
There is I don't see any exemption in either the Income Tax Act or the audit guidelines or the Companies Act where I can expense out capital asset, which has a useful life of more than 1 year. If it has a useful life of less than 1 year, you can expense it out. Otherwise, has to be capitalized. So my colleague informs me that earlier Schedule 6 used to have this clause of less than 5,000 you could expense out, but now there's no such clause. So these assets will have to be recorded in the fixed asset register and verification will have to be done.
Okay, thank you, sir. So, as we come to the end of today's session, I would like to extend our heartfelt gratitude to you, Sandeep, sir. Your expertise has truly enriched our understanding, and we will carry forward this knowledge and the inspiration gained today in our professional journey. So, thank you so much, and over to you, Kunal.
I would just like to conclude by extending a warm thank you, warm gratitude to you, sir. As they say, experience is the teacher of all things. And as young chartered accountants, looking up to our senior chartered accountants who hold this profession in true stride, it's been an honor to host you, sir. We look forward to hosting more sessions with you and helping our esteemed fraternity gain more through your valuable wisdom, because I think what you have gained through your experience of practicing for so many years, it's important, I think, for the fraternity to sort of know about that and learn from that. So looking up to you, sir, and thank you so much. I look forward to hosting you more.
Thank you so much. Thank you, Anilji.
Thank you, Kunalji. Thank you, Kunalji. Thank you, Nikita ma'am, for wonderful coordinating this webinar. On behalf of Auditing and Assurance Standard Board, I extend my heartiest thanks towards today's learned speaker, Sri Sandeep Dinodia ji. It was a wonderful session and full of interaction and full of questions along with the moderators. So thanks to Nikita ji and Kunal ji for making it so interactive and so today we have presented this webinar in a different manner. In after each clause, you have raised certain question and you have taken all the participants' question also. So thank you so much, Nikita ji and Kunal ji. And once again, sir, thank you so much from the core of my heart. You have given us time and you are always available for the profession. And apart from having very busy schedule, you have kind enough to give us this your precious time, sir. Thank you so much, sir. Thank you so much.
Thank you for giving me this
And,
opportunity.
yes, sir. Thank you, sir. Thank you. I also request all the participants to please join our next part 2 webinar on 14th of this month at 4 p.m. and third part on 16th of this month at 3 p.m. So we'll be covering more clauses, rest of the clauses on 4th, some of the clauses on 4th, 14th, and rest of the clauses on 16th. So kindly join on 14th at 4 p.m. and 16th on 3 p.m. Thank you so much. Good evening. Thank you.